Hi guys, hope everybody's well. Let's get going for the session, and let's just talk a little bit about yesterday. Actually, first off, let's bring up the S&P for looking back over the last 10 days actually, and we've had a very nice bullish run. Couple of hiccups in there along the way, but generally sentiment has been good. We managed to get up above 1100 earlier in the week, and since then it's just been a little bit, it's been sideways. We've been consolidating above 1100. The earnings that we've had coming through have still on the whole been good news, and particularly again this morning, I'll talk about it in a minute, but the European earnings this morning have been fantastic, which has really led to the upside that you can see off yesterday's low. But yeah, we've run out a bit of steam. We have come a long way in quite short order on the upside, so that the strength of that rally just tailing off a little bit, and that's largely due to, again, going back to bad economic data out of the US. So earlier on in the week, of course, consumer confidence was just shy of the expected, and yesterday back to the same theme, and we had the durable goods orders released, and it was disappointing news. There was no other way of looking at it. And then also the other economic data release from yesterday was the Fed's Beige Book, which is the report published 2 weeks before the FOMC meeting that they use for that monetary policy meeting. So it is important, and what that showed us last night was that 2 of the 12 federal districts actually saw a slowdown in economic growth over the last 6 weeks. So 2 out of 12 saw a slight slowing, 2 out of 12 saw flat economic activity, and the other 8 saw continued moderate growth. Okay, so that was kind of the headline news from that report, and markets didn't. It took, like always with those reports, there's a lot of detail in them, and it does take time for the market to digest it and then respond, and that's what happened last night. The announcement came at 7 o'clock, but it wasn't really until sort of 7:20 until we started to sell off, and we went through. We eventually got through, properly got through our key level at 1107 and moved down and had a test of another key support level at 1099. Those were the highs from middle of July. We hit that several times earlier in the month, and that acted as a great support last night. Just in about 8 o'clock, moving down, finally getting to 1100, just dipping underneath it, finding nice support off those longer term or medium term levels, I should say, from the highs earlier on in the month. And from that point, we've been steadily climbing. Again, it's slow activity, it's low volume. That's the kind of nature of this market at the moment, especially when it's on the upside. The big volume really is only coming in when we get negative news flow that creates large moves down. Otherwise, the market's happy grinding higher on low volume. So a couple of hiccups yesterday with those, with the durable goods and also the Beige Book. Also, we had the oil inventory numbers at 3:30, and they were spectacularly bearish. 7.5 million barrel build in crude stocks. As I said at the time, one of the biggest builds I can remember, and oil has been coming off. Let's look at oil whilst I'm talking about this. It was a strange reaction to the actual figure, but if you look back over the last couple of sessions, it kind of makes sense. So we had a big drop on the 27th of July, where we moved from the kind of high of the range over the last month or so up at $80. We had a sharp sell-off, ultimately bottoming out on the 27th, bottoming out around about 76, 77. So yesterday on the news, we only ended up dropping about 50 cents, and we dipped under $76 and found support at 75.90, which was a key level from the 22nd of July. So at the bottom of the range over the last week or so. So this really exaggerated move on the 27th, and then a further less exaggerated move on the actual data release. The bearish oil numbers took us down to those lows. But pretty much immediately after the announcement, that initial spike lower got completely reversed, and we actually ended up trading above where we were before the bearish number was announced for the rest of the session. So it's one of those classic examples with the oil market where, you know, a lot of the news or a lot of the news flow is kind of known already within the oil industry, and you often get big moves in the oil price without really understanding why, and then sort of 24 hours later all becomes clear. So it was a classic example of the market reacting aggressively to that bearish number the previous day. For now, we're sat on $77. We've stabilized, similar to stocks. You know, we hit lows last night, but since then we have been, if anything, slightly trending higher, or more like oil's consolidating the big sell-off that we saw on the 27th. As you know, those oil inventory numbers were incredibly bearish. So that oil number just kind of threw the market as well yesterday, particularly these stocks. They came off initially, but as I said, the reaction was a strange one because we ended up rallying afterwards. So I'd say yesterday's session really just saw the market being stuck to the key long-term level of 1107. It's the 50% fib level for the year. It's also, well, there or thereabouts the 200-day moving average. That's kind of moved a little bit higher now. It's about 1108 today. But key level for two reasons on the long term, and really the market's just gravitated towards that yesterday. It spent a lot of the session just above it, testing it as support. We finally got through it, and then we spent most of the rest of the session just below it, testing it as resistance. And we're kind of back onto that now after the decent earnings that we had out of the Eurozone this morning. So that's really the main news out of Europe. Has been good earnings from the likes of AstraZeneca, Bayer, France Telecom, Telefonica. Okay, so big European companies coming in with really nice earnings. Largely speaking, the economic data out of the Eurozone has been roughly in line. We've had German unemployment, as expected, at 7.6%. Eurozone consumer confidence in line as expected at -14. The Eurozone business confidence slightly better though. But largely speaking, the economic data hasn't really moved much today. It's been roughly in line, and it's been the earnings that have generated the upside that we can see in the stock markets. Also, the earnings from the US that we've already had, actually a bit of a mixed bag, because Motorola earnings were very good. Their stock price is up over 2% in pre-market trade. They beat on the earnings per share and on the revenue quite nicely. But to counter that, Colgate, Palmolive, disappointing. Their revenue was in line, their earnings per share was in line at $1.17, but their revenue was $3.81 billion, so under the expected 3.94. So a little bit disappointing from Colgate. We're still awaiting the main earnings release of the day. That is the biggest stock in the S&P 500, ExxonMobil. So we're expecting those numbers at 1 o'clock. We have an earnings per share forecast at $1.45, and we have a revenue forecast at a quite staggering $98.67 billion for the quarter. It is quite a mind-boggling number, including weekends. That's over $1 billion a day revenue ExxonMobil rake in. You know, they are the biggest company in the world, so just quite a staggering number though. I mean, they could be breaking later on in the year, they'll be looking to break the $100 billion per quarter revenue. So ExxonMobil at 1 o'clock, guys, and really I think it will be those earnings that have generated most of the movement. We have had one other event which could be of major importance. I'm going to bring up the euro dollar to talk about this, because we've had this morning an interesting comment from Moody's, the ratings agency. So they've said this morning that the US government needs to articulate credible fiscal consolidation plan, and if the US budget debt projections are realized, Moody's would need to review its rating on US debt. Moody's said that political uncertainty over the US government's ability to tackle debt. They said that the US government currently has no plan to deal with rising debt. You know, that's a pretty major comment from Moody's. It really just brings to the forefront the whole US debt issue, which, largely speaking, has remained under the carpet to date, and really it's been the European debt crisis that's been dominating these markets all year. So now that the Eurozone has been dealing with it, announcing austerity, and implementing austerity. Now it seems like the ratings agencies have turned their attention to the other side of the Atlantic, and we'll see what happens. I mean, these ratings agencies, they like to stick their nose in. Whether or not the other two major ratings agencies, S&P and Fitch, whether or not they're going to comment on that following Moody's comment this morning. But you can see what's happened with the dollar, because the euro dollar rallied. It rallied through yesterday's high. Okay, we traded up on an 11-week high